Debbie standing by in Edmonton. Go ahead, Debbie.
Hi, David. I'd appreciate it, knowing what you think of Macquarie Infrastructure, please.
Sure. You got it.
So, Debbie, infrastructure assets, I just want to touch on this for a moment. Years ago, pension funds for their long-term liabilities used government bonds as the way that they funded those in a large part. And then along the way started looking at real estate and infrastructure as long duration assets that had a predictable revenue stream that maybe gave them a better return than what they were getting from their bonds. So they made excess return on another long duration asset. And as a result, the extra return you could get in real estate and the extra return you get in infrastructure has been sort of squeezed out over the years to trade more like a bond than the excess return they got when they first started. And so they've been revalued over the last 15 or 18 years. And, you know, today with commercial real estate at like high quality buildings trade for 3% cap rate, makes it look a lot like a bond, right? Mm-hmm. So how much better can it get if interest rates start going up? So in general, I'm not a fan of infrastructure right now because I believe we ended a 35-year fall in long-term interest rates in 2016, and for years we're likely to see them rise going forward. So that's a backdrop. So infrastructure, not my favorite place. Macquarie's infrastructure fund obviously just took it on the chin and has had quite a hit.
Just remind us what the trouble was there, David.
I have to be honest, sure. I don't know. All I can tell you is that it's really been hit hard in the market.
Yeah.
And so I would say the security itself has broken down. I mean, I have it dropping, precipitously.
Okay.
Now maybe that's a bad chart.
Okay. But you're not keen on the concept.
But I don't like the sector. Macquarie's infrastructure units fell from $85 to $67 in the 2 years of 16 and 17.
Okay.
And I have it now trading at $38. So technically it's broken. The sector's not attractive. I would move on.
Okay. VSN in Ottawa. Go ahead, VSN.
My question is on Magna International, the car maker. As you know, with the Trump administration floating this idea of a 25% tariff on steel and aluminum, I'm just concerned that it may take a big bite in terms of its potential revenues and profits. And as well with rising interest rates, do you think that's also going to slow down the demand for automobiles in general? So I just want to hear if you think there's still an opportunity to buy Magna on a downturn, or if it's time to exit, or to hold. Thank you.
Okay.
Magna International.
So the auto sector's had some headwinds recently, and especially those around North America. But I mean, even if you look at GM, the stock price has been punched in the last couple of weeks. So the group is under pressure. Magna is cheap relative to its peer group in assembly and in doing sub-assembly. So it's an inexpensive stock, and it's growing faster than its peers. If you own it at this point, it's sitting right on top of its long-term moving average, which is sort of a good judge as to whether it's in a positive trend or a negative trend. If it can hold at these levels and rally off it, then I think that you should continue to hold it. I would want to see it start to rally before I added to it at this point. It pulled back on the U.S. chart to $51 or $50.78 going back to the end of January. It's retesting those lows right now. So I would hold it, but if it breaks those levels, I would be gone.
Magna. Okay. Sorry. What's the level you want to see Magna? Can we
hold $51? Hold $51 US.
51. Let's put up the US listing for Magna, because I'm not sure if we looked at that one. So you want to see it hold at $51.
51 US, which is the low it set at the end of January.
And where is it?
And
now?
That's sitting right on the long-term moving average. It's not much above that. It
okay.
might be $51, $52.
No. So it sounds like you're not wild about Magna right now.
No, it's above long-term trend, but again, the sector's under a little pressure, and I'd want to see it start to improve before I bought the stock.
Ken in Kitchener, Ontario. Go ahead, please.
I really like your show. My question today for David is in regards to Capital Powers. I'm retired, and I'm looking for income, and Capital Power has a yield of almost 7%. They've also talked about increasing their dividend out to the year 2022. and I'd just like your take on it, what you think of the company. Thank you.
The electricity player.
Sure. So, one of the concepts is when interest rates are rising, you want to own things with a rising dividend stream to help offset. And so Capital Power fits into that camp, although it's not growing rapidly. They've grown their dividend over the last years about 6% a year. Again, you're investing for total return, and total return means dividend plus capital appreciation, and the sum of the two is your return. So, Capital Power share price has been falling along with the utility sector since August. I don't see signs of that changing in the near term, the sector getting a lot better. Capital Power may grow its dividend a little quicker than some in the group. If you own it simply for the dividend stream, you're going to get the dividend stream. I just worry that you're passing up on an opportunity to own something with faster dividend growth. So let me make a point. In the 50s and 60s, when rates started to rise the last time, the 10-year return for the bond market in the 50s was negative, right? Negative. Got better in the next 10.
Oh, after inflation, yeah.
No. Before inflation, it was negative. The price of bonds fell as rates rose.
So the return was...
The total return was
yeah.
negative,
okay.
Right? The next 10 years of the 60s, 1.5% a year, but then inflation was between 2.5 and 5, so you lost money there too. So in that period, people stopped buying bonds and started taking money from their bond pile and buying dividend growth stocks. And by the end of the 60s, we had a full-blown crazy mania in dividend growth stocks, the Nifty 50 that trade at 60, 70, 80 times earnings. That's what I think can happen over the next 20 years. You want to own things that are growing their dividends at 12 or 14 or 15% a year, and they're out there. 6% a year is probably not that attractive in a rising rate environment.
We'll be back after this. David Burrows taking your questions on North American large caps, 1-855-326-6266.